Okay, what in the world is going on in the Nashville real estate market? So is this the death of bidding wars? Is the crash finally coming? Can you finally buy a house here without having 1,000 other offers on it? As you know, the Nashville market has been absolutely crazy. I've had clients lose out with offers of 300,000 over asking here, multiple offers on almost every single property, and properties disappearing while they're still incoming soon. So is this finally the end of that? And I know a lot of people go off of feelings. They say, this feels like this point in time. But it's really important to stay focused on the data and take a look at what the data has to say, because that is really what is telling about what is happening in the market, and not just how things necessarily feel. Just because it feels a certain way doesn't necessarily mean that's the way that it is. So we're going to take a look at some of that data and some of the things that have come out recently and just go through that together, and we'll come to some conclusions. The last point I'm going to make about foreclosures is probably going to blow your mind, so be sure and stay tuned for that. So hi everyone, my name is Jennifer Gramling. If this is your first time visiting my channel, I'm a real estate agent here in the Nashville and surrounding area, and I just put out weekly videos trying to help you get more familiar with Nashville. If you're thinking about moving here or relocating, this is going to be a great place for you to learn about neighborhoods, things to do. So be sure to subscribe and hit that notification bell so you can be the first to see these videos as they're coming out. So let's go ahead and jump into some of these articles and some of this data that I was talking about so that we can kind of take the temperature on the Nashville housing market. Okay, so the first thing we're going to take a look at here is this graph on recessions. So there is some talk that we are heading into a recession, or that we may already be in a recession, which would make sense because of all of the money that we've been printing. It's almost unavoidable. We can see inflation has just gone crazy. So does a recession automatically mean that housing prices are going to drop and the market is going to crash? Let's go ahead and take a look at this. So if we go back, CoreLogic, they are a data collection company. They put together a lot of different stats and numbers for real estate and things like that. So they went back and they took all the numbers from past recessions, at least these past recessions from 1980 going forward, and went ahead and compiled the numbers to see what the housing market looked like during those times. And if you take a look back here, you'll see in 1980, housing prices during that recession still went up 6.1%. So they did not go down in that recession. Same 1981. 1991, they dropped only by almost 2%. So really not that much. 2001, housing prices still continued to increase. And then in 2008, as we all know, that was the big crash where housing prices dropped 19.7% as a whole. But in some areas, I mean, where I was living at the time, Denver, I had a condo that dropped by probably almost 55%, 60% by the time it was done dropping. But then bounced back, by the time the market had corrected itself and come back to where it should have been, I did end up selling that for a lot more than what I paid for it. There are peaks and valleys in every real estate market, but it always trends up eventually. And so during those times, you're definitely going to want to pivot. I had that as a rental, and since selling was not a strong market, the rental market was very strong. I had some fantastic renters. By the time I sold that property, I did make quite a bit of money on it. So it actually was a great investment as long as you hold on to it. Sell low, it's never a good idea. So if there's any way you can hold on to those properties if there were to be a dip, that's the better plan. And then 2020, we had that micro recession. Housing prices still continue to go up there. So as you can see, ever since 1980, really only the one recession had a big drop in housing prices. So all that to say, even if we're heading into a recession, that doesn't necessarily mean that housing prices are going to drop. There's a lot of other factors that are going into these housing prices and things like that. So don't necessarily take that if we're heading into a recession that automatically housing prices are going to crash. We need to keep that in mind. But what is the other thing that we know? What we know is that mortgage rates have spiked, and that's really what has made the big difference and really cooled off demand for some of these houses. And let me give you my theories on that and who that's going to affect. So if we take a look here at Optimal Blue, we can take a look at the current market rates, and they actually did go down a little bit. So the current 30-year FHA is 5.2 right now. 30-year conforming is 5.3. So if we go back, we look at this pre-pandemic, we were kind of right here in November, December of 2018, we were right at that 5%. So here at 5.3, 5.25, we're kind of right back to where we were pre-pandemic. So we're not grossly over where we were pre-pandemic. We're just kind of getting back to a normal interest rate, at least for now, until it kind of dampens some of that inflation. Now, could interest rates continue to go up? They could. And I think some of that uncertainty is where people are getting tripped up with this housing market. And the people that I think will be affected the most are probably going to be new home builders. So let's quickly take a look at this article that just recently came out by CNBC. So sales of newly built homes tumbled over 16% in April while prices soared. So if we go down here, take a look at this. Sales of newly built homes dropped 16.6% in April from March, far more than expected, and were down 26.9% from April 2021, according to the U.S. Census. It says that is the slowest pace since April 2020, when everything shut down at the start of the COVID pandemic. Sales surged quickly after that as Americans sought bigger homes with outdoor spaces for quarantining. So we know that home sales just jumped in April 2020. It says these numbers are based on signed contracts during the month, not closings, so it is perhaps the most up-to-date indicator in the housing market. Mortgage rates, which have been rising since January, really shot up in April. The average rate on the 30-year fixed loan began the month at 4.88 and ended at 5.41. And with consumers being hit by rising interest rate and 4-decade high inflation, that is making it even harder for them to afford today's higher home prices. The median price of a new home in April was $450, an increase of nearly 20% from the year before. And in markets like ours, some neighborhoods are 30-40% increase from where they were before. So that's going to make it a little bit harder. And then it goes on to say, while new construction gained favor with many would-be buyers over the past 2 years due to the extreme shortage of existing homes for sale, the rising cost of a new home is now pricing many people out of the market. The market for new homes is mirroring broader real estate trends as rising inflation is taking a bigger chunk out of Americans' paychecks and surging borrowing costs are compressing home buyers' budget. And this is something that my clients are starting to run into. I just had this conversation with a client who was looking for a new build, has been waiting for these homes to be released, but with the rising cost of labor and material shortages and labor shortages and all of those things, not only is the cost of the build going up, but also the cost of their financing is going up. And the other thing I think with new builds is just the unsurety of what that cost is going to be when they finally close. So if you're starting from the dirt and you can't lock in a rate for a few months, you have no idea what your rate is going to be when you finally close, at least for a few months. And so with that uncertainty, their payment could change hundreds of dollars between now and then. So some people, I think, are going to then be pushed towards resale homes instead of those new builds, which I am seeing more of, people moving away from those new construction homes with the uncertainty of rates towards something that is a little more sure. If you see a price of a house right now and you know that you can afford this today and you can buy this today, that's going to be more appealing than putting down a deposit on a new build when you don't know where that price is going to end up by the time you end up locking that rate and closing. So I think it's going to push some of those people who would be buyers for those new builds into those resale homes, pushing up those demand even more for those resale homes. And then it also goes on to say builders are also starting to see an uptick in cancellation rates. While those have not shown up in earning releases yet, analysts who follow the builders are beginning to report it. So again, I think that goes back to people are canceling because what they put under contract or what they were going to build, they may have put that under contract back in November when rates were much lower. If their payment has increased by hundreds of dollars, that may be out of their budget now. So I think some of those builders are going to start seeing some of those cancellations. You may start seeing some of those houses come back on the market for people who could once afford it, maybe can't afford it anymore. Okay, and then I just want to go back here and highlight this middle paragraph really quickly. So a stark pullback in demand and not over construction is hitting the market. This is specific to new builds. So housing starts have actually been falling over the past few months. Slower sales caused the inventory of newly built homes to jump sharply to a 9-month supply. A 6-month supply is generally considered balanced between buyer and seller. We haven't had a 6-month supply of homes in a really long time. So I want you to remember that number. 6 months is a healthy supply of homes to be a balanced buyer-seller market. So we're going to go ahead and take a look at what that looks like right now in Nashville, how we're approaching if we're moving towards a buyer's market or if we're more likely to stay in a seller's market or be balanced. Let's take a look at some of those numbers. Okay, so as I said before, 6-month supply would be a healthy buyer-seller market. It's a balanced between the two. Enough homes for enough people who are looking. So that's going to be the perfect buyer-seller market. And so I just want to show you kind of where our numbers right now in the Nashville market so you can kind of compare. So right now, as of April 22, we don't have out our numbers yet for May, which I think will be pretty telling. But if you look at April 22, we're at 2.4 months of supply which is kind of the lowest that we've been in a very long time. So even if you go back here, you can scroll back pre-pandemic, and we had twice the amount of inventory pre-pandemic, and it was still only 4.2, 4.3. We kind of hit a little peak here in June 2020 of 4.5 months of supply. So we were a little bit approaching, but I think that was a little bit of panic. After we were locked down, people thought there was going to be a big housing crash, and there wasn't. So more houses hit the market. So you see that 4.5, but then it just continued to decline. And then to just kind of show you, so that's June 2020. If we look at how many homes for sale, in June 2020, there were almost 20,000 homes for sale. Today, we're 6,000 homes short of that in the Nashville market. So 6,000 homes would have to hit the market just to get us back up to this number here. But as you can see, it's still been declining all the way up until April. And that's why I say May will be very telling. So if we have a spike here from April to May, that will really tell us something. So we'll need to update after that. But this just kind of gives you an idea of where we're at. Okay, and just for fun, let's just go back and see if we can find a time when we were at that 6%. So if I go back here in November 2011, 12, you can see we are well over that 6 months of supply. And going back all the way here to 2009, we're at 20 months of supply of inventory, 10 times as much inventory as we would have now. So if you go back all the way trying to find that 6 months inventory where it was a balanced market, you're looking at about 2014. So 2014 was really the last time we were that high as far as inventory. And this is where we sit now. So we have a long way to go and a lot of inventory to add before we would ever be in a buyer's market. Okay, and now keep in mind, a lot of this might be market dependent. So you might see housing prices drop in one location and not drop in another. So let's go ahead and take a look at this article by Fortune magazine. So the odds of a home price correction just spiked. This interactive chart shows if your local housing market is at risk. So as we know, central bank has already put immense upward pressure on mortgage rates, which have spiked from 3.11 to 5.25 over the past 5 months, as it works to cool off one of inflation's biggest drivers, the booming U.S. housing market. If policymakers can slow down housing, they have a shot at slowing down overall price growth. It goes on to say we're already seeing the U.S. housing market slow down in the face of spiking mortgage rates. Mortgage applications are declining, fewer listings, and getting multiple offers, and inventory levels are rising again. However, that's a deceleration, meaning prices are going to go up at a more modest rate, not a price correction. So what that means is housing prices will still be increasing, just not at the rate that they were, more at a normal pace. 20%, 30% a year is not sustainable. It's not normal. So what this is saying is, yes, they're going to continue to go up, but the rate at which they were going up is going to slow down a bit. So, and you can read through this. I'll link to this in the comments in this Fortune magazine. So in order to determine the likelihood of regional home prices dropping, the real estate research firm assessed factors like income growth projections, unemployment forecasts, consumer confidence, debt to income ratio, affordability, mortgage rates, and inventory levels. Then CoreLogic, which we looked at an article from them earlier, put regional housing markets into one of 5 categories grouped by the likelihood that home pricing in that particular market will fall over the coming 12 months. So the groupings are high, very high, medium, low, or very low. So we've got this little handy interactive map. And if you go through here, so some of these red, Lake Havasu, Prescott Valley, Bend, Oregon, some of these are very high on the risk that your housing prices there are going to fall. Very low is the lowest category you can be. And here we are right here. Nashville, Davidson County, Murfreesboro, and Franklin. So we are on that very low list of possibly having our housing markets crash. And that is due to supply and demand. Again, like I said, a lot of this is going to be market dependent. So we have a large amount of people moving here to Nashville, moving here for jobs, moving here from Western states for other reasons, for tax reasons, financial reasons, cost of living, and quality of life in Nashville. So take a look at this article by News Channel 5. Nashville is the second hottest market according to experts. So in this article, they state Nashville has the music, culture, and now the jobs. Nashville continues to be the it city, with now the second strongest job market in the nation, according to an analysis from the Wall Street Journal and Moody Analytics. The top cities are Austin, Texas, Nashville, Tennessee, Raleigh, North Carolina, Salt Lake City, Utah, and Jacksonville, Florida. They're in mid-sized cities, all with a population under 2.3 million. The analysis shows they are in states with fairly low income taxes or none at all, and their climates will allow for outdoor activities year-round. It goes on to say the rankings measured 5 factors: the unemployment rate, labor force participation rate, job growth, labor force growth, and wage growth in 2021. An average of those rankings was used to determine the hottest labor market in the US. So again, it is going to be very market dependent. It's going to depend on what you have going on in your city. Supply and demand is just a really big factor in calculating all of this. So you have to keep that in mind. So if the demand is there, then the prices will continue to increase as well. So until that demand drops or the supply greatly increases, we're not going to see that crash. But what about all the foreclosures? That's the big question that everyone is asking. They're waiting for all those foreclosures to hit. Well, here's the thing. Let's take a look at some of those foreclosure rates, delinquency rates, and things like that. Okay, so let's take a look at this article from CoreLogic again. U.S. delinquencies dropped to lowest level in more than 23 years in February. So in February 2022, 3.2% of home mortgages were in some state of delinquency, 30 days or more past due, including those in foreclosure, which was a 2.5 percentage point decrease from February of 2021. So we're actually lower than February 2021, according to the latest CoreLogic Performance Insights report. This is the lowest recorded overall delinquency rate in the United States since at least January 1999. So I think there's some kind of perception that there's all of these houses in delinquency, people can't pay for their houses, that are about to go in foreclosure, but that's not what this data shows at all. So if you're waiting for that rash of foreclosures to hit the market, that's just not going to happen. And with that inventory shortage, it's going to have to be either new builds that are hitting the market to make up that deficiency, or people selling their homes. So instead of seeing a ton of foreclosures, what we're actually seeing have been really great lending practices, people with a lot of equity in their home. So if there was someone who lost their job right now, if they are in the same place that they were pre-pandemic, they probably have 30% equity in their home here in Nashville that they could use, even if they were on the brink of having to be in foreclosure back at the beginning of the pandemic. They likely have gained 30% equity in their home. So rather than be foreclosed on, they could sell, make that money, take that profit, and put that into another home or move somewhere else if they needed to do so. So they're not in that panic place of selling. Also, people are paying way more cash for their homes than they were previously. And before, back in the 2000s, with the shoddy lending practices, people weren't putting enough money on their house down if they were even putting any money at all. So when those prices dropped, they were upside down. Well, they wanted to make sure that wasn't happening anymore. And so now you've probably seen people waiving appraisals and all those sorts of things. Well, that doesn't mean that if the house doesn't appraise, they don't put the money down. What that means is they bring that extra cash to closing. So whether or not you think the house is overpriced, they brought that extra cash. So they likely have 20, 30, 40 plus % in equity in that house. So if those prices were to drop even 40%, 30%, they would very likely have that equity in their house where they still would not be upside down. But are we seeing the market cool? Yes, we're seeing it cool a little bit. We're seeing the demand coming down a little bit. What that means for my buyers is that this is a great time for us to buy a house. With a little less competition in the market, it's a little bit easier to get a house. Hopefully we won't be seeing those hundreds of thousands of dollars over asking right now. There are still multiple offers on properties. We don't want to say that there's not, but it's not quite as crazy as it was. So what that means is, again, this is a great time for you to buy a house in Nashville with this little bit of a cooling off period. It's a little bit of a break, and honestly, for me, it feels awesome. I've been waiting for this time, and maybe it just won't be quite as hard as it was in the past year and a half, 2 years or so. But as I said, I think that May data will be really telling as far as where the market is heading and what it's going to look like more as we go into summer. June, July, August are some of my busiest months. So hopefully more of that inventory will be hitting the market. But as those May numbers come out, we'll do another market update and check back in and just kind of see again where those numbers are heading and what that market is looking like. Again, my name is Jen Gramling. I'm a real estate agent here in the Nashville area. If you're thinking about moving here or relocating, be sure to reach out to me. All my contact information is in the comments. I'd be happy to answer any and all of your relocating questions, so be sure to reach out. Thanks so much, and I'll see you on the next video.